Let's talk about the role of financial markets. So financial markets facilitate price discovery. They improve liquidity, the ability to sell assets quickly. They lower search costs, the ability to find a counterparty very easily. They lower counterparty risk. Counterparty risk means if I agree to sell you something and you agree to buy something from me, counterparty risk is that I don't actually have the asset I claimed to want to sell, and you don't actually have the money to buy it. If we do this through an exchange, then the exchange can lower this risk by making good on these counterparty obligations. And later in the term, we'll talk a little bit more about different types of assets, different attributes of assets, and the different markets in which they trade and why. But in general, markets are competitive. The idea is that there's a benefit to paying attention, so people do pay attention. And the basic theory is you're compensated for this risk-return trade-off. People can correctly assess the return, they can correctly estimate the return, they can correctly assess the risk. And because markets are competitive, if you're going to earn more, then you're going to have to incur more risk. That's the idea. And so let's talk about an illustration. Let's talk about this idea of the coin flip game. And we're going to do this to understand risk aversion and this idea of the risk-return trade-off. And so here's the coin flip game. We're going to pay $1 to flip a fair coin. And you get heads if you get $2 if heads comes up, and you get nothing if tails comes up. So would you pay $1 to flip a coin? And the answer is probably yes. Most of us would pay $1 to flip a coin, $2 if it's heads, 0 if it's tails. But would you play for $10? Would you play for $100? Would you play for $1,000? Most of us would not play this game for $1,000. Now there's always some kid in class who says, well, I play blackjack at $1,000 a throw, and so therefore I would do it, but most of us would not do it. Now you might play 1,000 times for $1, but would you play one time for $1,000? Probably not. Okay, let's just spend a second reviewing some calculations, the expected return and the standard deviation associated with this game. So the idea is that the expected payout is 50% chance of having a $2,000 payout and a 50% chance of having a 0 payout. So the expected payout is $1,000. The return is going to be the price at time 1 over the price at time 0 minus 1. And so the return for head is going to be 2,000 over 1,000 minus 1 is 100% return. And the return for a tail is 0 divided by 1,000 minus 1 is minus 100% return. And the expected return is going to be the sum of each probability times the return. And we use small s for states of nature. So head is the state of nature and tails is the state of nature. And later we might talk about if the economy is an expansion or if it's normal or if it's in a contraction as different states of nature. And so I can see the expected return is the probability of a head times the return given a head, and the probability of a tail times the return given a tail. And so it's 50% times 100% plus 50% times minus 100%, and therefore the expected return is 0. And I think that's fairly trivial. We can all see that. And we can also see that the expected return is calculated this way as the expected payout. 1,000 divided by 1,000 minus 1 is also 0. Here's the standard deviation. The standard deviation is the sum of the probability of a state times the return given the state minus the expected return squared. And so that's the variance. The standard deviation is going to be the square root of that. And so it's 50% chance times 100% minus 0 squared plus 50% minus 100 minus 0 squared. And so we get 0.5 times 1 plus 0.5 times 1, and we get 100% variance. So a really big variance, a really big standard deviation. Okay, let me just show you the spreadsheet very quickly, and we can show you these calculations there. Here's the spreadsheet, which computes the expected return and standard deviation for the coin flips. Here's the cost of the coin flip. Here's the payoff if you have a head. Here's the payoff if you have a tail. The state is head and tail. Here are the probabilities. Note that all of my input cells are in green and all of my output cells are in orange. I will use that format throughout the semester. And so here is the state return, which is going to be the $2,000 divided by the 1,000 minus 1. Here it's $0 divided by 1,000 minus 1. Here is the expected return, which is going to be the probability times the outcome plus the probability times the outcome. And here's the equation for the standard deviation. And all I did was repeat the model so that I can do it again. So for example, if I pay $1,000 and I have a $1,200 and $800 payoff, note that my expected return hasn't changed, but now my variance is significantly lower because I have a 20% and minus 20% as opposed to 100% and minus 100% returns. And so here's just a little calculator that we'll use as we go through these this exercise. Now let's talk about risk aversion. Risk aversion is this behavioral assumption that we make about people. And what we're going to assume is two things about people. We are going to assume that utility is increasing in wealth. Therefore, the more wealth I have, the more utility I have. But we also have diminishing marginal utility of wealth. And from these two base assumptions, we're going to be able to draw a curve to show that a $1,000 loss is actually worse than a $1,000 gain. And this is why people will play this game for $1, $2 versus $0, but very often will not play this game for $1,000. And the reason is that the benefit I receive, the utility I receive from an extra $1,000 is smaller than the utility loss I would receive or utility loss I would incur if I lost $1,000. So an extra $1,000 would be great, but giving up $1,000 is so bad that people tend not to play these coin flip games for $1,000 because they are risk averse. And from this, we'll show that in order to induce people to incur risk, we have to compensate them. So let's just draw the graph very quickly and show risk aversion from these two simple necessary properties: utility increasing in wealth and diminishing marginal utility of wealth. So let's see if we can look at how risk aversion falls out of these two assumptions. And so what I want to do is I want to graph wealth, and then I want to graph the utility of wealth. And what I want to do is I want to graph this in such a way that the more money I have, the more utility I achieve, and so therefore utility is increasing in wealth. But I have diminishing marginal utility of wealth, meaning that as I move from a high wealth amount to a slightly higher wealth amount, I get a little bit of a utility gain. But if I move from a low wealth amount to a slightly higher wealth amount, I get a large utility gain. And the way to think about that is your $100th is worth more than your millionth dollar. So let me draw this. So it's upward sloping. And so therefore, utility is increasing in wealth, but it's upward sloping at a decreasing rate. And so I have a diminishing marginal utility. And what I want to do is I want to choose a initial wealth. And I want to see what happens when wealth goes up by a certain amount and goes down by a certain amount. And I'm attempting to draw these so that they are symmetric. And what I want to do is I want to show the utility gain from an increase in wealth and the utility loss from a decrease in wealth. And so I come over to utility. Here's my initial, here's my gain, here's my loss. And what we're attempting to show is that for a symmetric gain or loss in wealth, plus 1,000 or minus 1,000, I have an asymmetric change in utility. The utility loss from the loss in wealth far exceeds the utility gain from a gain in wealth. And this is the essence of risk aversion. The gain I would get from having an extra $1,000 is less than the loss I would achieve from losing $1,000. And from this we can assume risk aversion. So we have risk aversion. We know that a $1,000 loss is much worse than a $1,000 gain, so people don't play this game. So how do I get you to play? How do I induce you to play? Well, I can do two things. I can increase the amount that you get compensated in terms of the return, and I could lower the risk, lower the standard deviation. So I increase the return by lowering the cost. So again, let's think about this. it costs you $1,000 to flip a coin. You're going to win 2,000 or you're going to get 0. If I charge you $1,000, you're not going to play, but what if I charge you $900 to win 2,000? So now you might lose 900, but if you get it right, you're going to win 1,100 now. Would you play for 900? How about 800? What about 700, 600, 500? Well, at some point, the loss of $500 versus the gain of $1,500, that gain is so great that I've now overcome that essential curvature in that graph so that the utility gain exceeds, or at least meets, the utility loss. And so by increasing the return by lowering the cost, I can see that I go from a 0% return to an 11% return to a 25% return. And so now I can get you to play by increasing the return. And if I go back to that spreadsheet, we can show these numbers. And back to the spreadsheet, I can see if I lower the cost, here I have a 0% return at $1,000. If I go to $900, I can see I have an 11.11% return. And if I go to $800, I can see the return goes to 25%, $700, the return gets lower, gets higher and higher, and once the cost gets lower and lower, and this is how I might induce you to play this game. So people will play the game as the return increases and the cost lowers, or the cost lowers and the return increases, but for some sort of fixed amount of return, lowering the risk or narrowing the payouts will also induce people to play. So again, $900 with a 2,000 or 0 payouts is going to have a standard deviation. Sorry, it's going to have a return of 11.11%. But here I can see that the standard deviation of the return, if I change the payouts from 2,000 and 0 to 1,500 and 500, the return doesn't change, but the risk changes. And again, I can do it again if I have the cost still at $900, but the payouts are $1,200 and $800. Again, the return doesn't change, but the risk gets narrower and narrower. And let's just go back to the spreadsheet and take a quick look. Okay, so back to the spreadsheet. And so here I have a $900 cost, and payouts are 2,000 and 0. So I can see that I have a very high standard deviation and 11% return. I'll just replicate it over here, $900, 2,000 and 0. And the first thing I did was I changed this to 1,500 and 500. Note the return doesn't change because the expected payout is still 1,000 on 900, but note that the standard deviation gets lower. And in the second example, I went to a $1,200 payoff and an $800 payoff, and now I can see I still have that same return, but a much lower standard deviation, a much lower risk. So I can see same cost, 900, same expected payout, 1,000, but I have a much lower risk. And so you are much more likely to play this game because there's a lower risk associated with your 11% payoff.